Welcome back, future CPAs. This is part one of our series, Financial Reporting, which covers the first area of the Financial Accounting and Reporting section of the AICPA exam. If you're new here, don't forget to hit subscribe and share this with your fellow CPA candidates who are looking for quality review materials for free. This program is built to help you learn more efficiently in less time. We start with multiple choice questions as the foundation, then zoom out to connect them with key topics that align with the AICPA exam's representative tasks. The visuals are kept minimal on purpose, so you can also treat this like an audiobook, perfect for maximizing your study time on the go. Wishing you the best on your CPA journey. All right, candidate, let's read this question carefully because the devil really is in the details. A preparer is finalizing the year-end balance sheet for a for-profit business. The trial balance shows a $500,000 short-term note payable. After year-end, but before the financial statements were issued, the company refinanced that note on a long-term basis. So, here's the big question. How do we treat it under US GAAP and SEC rules? Okay, let's walk through the choices one by one. Choice A says, recognize the liability at $500,000, classify it as current, present it under current liabilities, and no disclosure is required. Well, the recognition part is fine. $500,000 is still owed, but calling it current? That ignores the refinancing. GAAP tells us that if refinancing happens before the financial statements are issued, you can classify it as long-term. And the idea of no disclosure? That's a hard no. So choice A is out. Choice B says, recognize the liability at $500,000, classify it as non-current based on the refinancing agreement, present it under long-term debt, and disclose the refinancing terms in the notes. And honestly, that's exactly what the guidance says. ASC 470 is crystal clear here. The debt is real, it stays at $500,000, but refinancing before issuance lets us move it to non-current. And yes, disclosure is required. So choice B is looking like our winner. Choice C says, don't recognize the liability at all, just disclose the refinancing in the notes. And that's a fantasy. Refinancing doesn't make $500,000 magically disappear. GAAP doesn't let you wish away debt. So choice C is definitely wrong. Choice D says, recognize the liability at $500,000, keep it in current, but disclose in the notes that refinancing occurred. Now this one's sneaky. Recognition is fine, disclosure is fine, but leaving it in current is wrong because refinancing was done before issuance. GAAP lets us reclassify. So this one is an almost, but not the right answer. So, final verdict? The correct treatment is choice B. Recognize $500,000, classify it as non-current, present it as long-term debt, and disclose the refinancing terms. Now, let me show you how they twist this question. What if the refinancing happens after the financial statements are issued? Too late. The note stays current and you just disclose it as a subsequent event. What if you've signed a firm refinancing agreement before issuance but haven't actually borrowed the cash yet? That's still good enough to reclassify as long-term. And here's a curveball. Under IFRS, refinancing has to be completed by the balance sheet date itself. No waiting until issuance. So IFRS is stricter than GAAP. So the big lesson here? Timing is everything. If refinancing is locked in before the statements go out the door, you can move it to non-current. If not, it stays current. And either way, you disclose. Think of it like moving a party from your apartment to a banquet hall. If you book the new hall before you send the invitations, that's before financial statements are issued, then the party's officially at the hall. If you wait until after the invitations are already sent, well, you're stuck hosting everyone in your cramped apartment, and you'll just have to explain it in the notes. All right, candidate, let's go through this one. The trial balance shows inventory of $2 million, but during the review, the preparer discovers that the controller made a mistake. Instead of recording inventory at cost, they recorded it at selling price. The actual cost is 1.4 million, and the net realizable value, NRV, is 1.5 million. So the big question is, what adjustment is required? Now, before we even peek at the choices, let's remember the gap rule. Under ASC 330, inventory is measured at the lower of cost or net realizable value. Cost means what you paid for it, FIFO, LIFO, average, whatever your method is. NRV means what you expect to sell it for, minus costs to finish and dispose of it. And GAP says pick whichever number is lower. That's conservatism. Okay, now let's take the choices one at a time. Choice A says adjust inventory to 1.5 million because GAAP permits inventory to be carried at NRV when that amount better reflects realizable value. That sounds nice, right? NRV is in the codification and it even says realizable value. But here's the catch. NRV only replaces cost when NRV is lower than cost. In this case, cost is 1.4, NRV is 1.5. Cost is already lower, so if you pick 1.5, you've skipped the first step in the rule. This is a very common trap, so choice A is wrong. Choice B says adjust inventory to 1.4 million because GAAP requires inventory to be reported at the lower of cost or NRV. This one is clean. Cost is 1.4, NRV is 1.5. Lower of the two is 1.4, so we adjust down to that amount. That's exactly what GAAP wants. Choice B is correct. Choice C says adjust inventory to 1.4 million, but also recognize a gain of 100,000 because NRV exceeds cost. Oof, this is sneaky. Some people think, well, if I can sell it for more, shouldn't I record a gain? But GAAP says no. We don't write inventory up above cost. We only write it down when NRV falls below cost. No anticipatory gains are allowed. Under IFRS, you can reverse a prior write-down if conditions improve, but even IFRS doesn't let you book a gain just because NRV is higher. So this choice is wrong. Choice D says, adjust inventory to 1.4 million and disclose in the notes that inventory is measured at cost, which was below NRV. This one sounds pretty official, right? But GAAP doesn't require you to disclose every time cost is lower than NRV. What GAAP requires is disclosure of your cost method, FIFO, LIFO, average, and if you had to write inventory down, you disclose that too. But here, there's no write-down. Cost is lower, so you simply record cost. No special disclosure needed. So while it sounds fancy, choice D isn't correct either. So after walking through all four, the clear answer is choice B. Inventory should be reported at 1.4 million, the lower of cost or NRE. Now, let's spice this up with a few variations you could see on the exam. What if NRV was 1.2 million instead of 1.5? Then cost is 1.4, NRV is 1.2, and now NRV is lower. In that case, you'd report inventory at 1.2, and you'd disclose the write-down. Another variation. What if the company uses LIFO? Under LIFO, GAAP applies a slightly different lower of cost or market model, where market is defined as replacement cost with certain limits. That's extra tricky, but the conservatism principle is the same. Don't overstate. And one more twist. Under IFRS, inventory is also lower of cost or NRV, but unlike GAAP, if NRV goes back up later, you can reverse the write-down. GAAP doesn't allow that. So here's the key takeaway. Conservatism wins. Inventory is always at the lower of cost or NRV. No upward adjustments, no close enough disclosures, just the right number on the face of the balance sheet. Think of it like this. Reporting inventory is like bragging about your basketball skills. You don't get to say, well, I could probably score 30 points if I had a good night. You report what you can actually deliver right now. GAAP wants the real conservative number, the one you can defend today, not the one you're dreaming about tomorrow. All right, let's work through another balance sheet classification problem. This one's about long-term debt and how we split it between current and non-current. Here's the setup. On December 31st, a company has a $1 million equipment loan. It's payable in 5 equal annual installments, and the first payment is due in 6 months. How should this loan be classified on the balance sheet? Let's go through the options. Choice A says classify the entire 1 million as a current liability. Now, that's way too extreme. Current liabilities are only those obligations due within 1 year or the operating cycle, whichever is longer. In this case, only the first installment is due within 12 months. That's 200,000. The other 800,000 is spread out over the following 4 years. So calling the entire 1 million current would overstate short-term obligations and mislead users about liquidity. Choice A is wrong. Choice B says classify the entire 1 million as a non-current liability. This is the opposite mistake. Not all of it is due beyond 1 year. 200,000 is clearly payable within 12 months, so that portion must be shown as current. Choice B is wrong. Choice C says classify 200,000 as current and 800,000 as non-current. Now this lines up perfectly with GAAP. Under ASC 210, we separate liabilities between what's due within 12 months and what's due later. Recognition, the liability exists, no question. Measurement, 1 million total, split based on timing of repayment. Presentation, 200,000 under current liabilities, 800,000 under non-current. Disclosure, in the notes, you'd provide the repayment schedule, interest terms, collateral, all that detail. So choice C is correct. Choice D says classify 200,000 as non-current and 800,000 as current. That's just backwards. It's like putting your shoes on the wrong feet. You technically have them on, but it doesn't make sense. So choice D is out. So the right answer here is choice C, 200,000 current, 800,000 non-current. Now, let's take this a step further. The exam might tweak this scenario in subtle ways. For example, what if the lender waived next year's installment before the financial statements were issued? In that case, GAAP allows you to classify the entire amount as non-current because there's no current obligation anymore. Or what if the loan agreement had a covenant violation at year-end? Then, unless the lender formally waived the violation before issuance, the whole amount could become current, even if the installments were technically long-term. Or, one more twist. Under IFRS, refinancing has to be complete by the balance sheet date to reclassify debt as non-current. US GAAP is more flexible. It allows reclassification if refinancing is arranged before issuance. The big concept here is classification. It's not enough to know the total liability. You have to split it between what's due soon and what's due later. This gives users a clearer picture of liquidity and solvency. Think of it like this. Current liabilities are the bills that will find you before your next birthday. Non-current liabilities are the ones haunting you after that. GAAP wants financial statement users to know the difference so they can see if the company can cover its short-term obligations with short-term assets. So, final answer, choice C, 200,000 current, 800,000 non-current. That's Balance Sheet Structuring 101. All right, let's dive into a classic related party loan question. Here's the setup. A company borrows $100,000 from its majority shareholder. The loan is payable in 3 years, and there's no stated interest. The big question is, how should the preparer report this on the balance sheet? Let's take the choices one by one. Choice A says, recognize the loan at $100,000, but classify it as a current liability since no interest is charged and the obligation is not an arm's length transaction. Now, this is tempting because it looks like you're acknowledging the loan, which is correct, but the classification is the problem. The maturity is 3 years away, which makes it a long-term obligation, not current. The lack of interest doesn't magically make it payable right now, and the fact that it's a related party transaction doesn't change the due date. So while this answer feels plausible, it misclassifies the liability. Choice B says recognize the loan at 100,000, classify it as a long-term liability, present it under notes payable, and disclose the related party nature in the notes. This is the clean, correct treatment. Recognition, the loan the company owes 100,000. Measurement, at the principal owed, unless there's a separate requirement for discounting, which we'll talk about in a minute. Classification, non-current because it's due in 3 years. Presentation, notes payable under long-term liabilities. And disclosure, ASC 850 requires us to disclose related party transactions, including the nature of the relationship and the terms. So this one ticks all the boxes. Choice C says, recognize the loan at 100,000, but measure it at present value, imputing interest, with the difference recorded as additional paid-in capital. Now, this one sounds very technical, and it borrows language you've probably seen in advanced accounting. Imputed interest is real. GAAP requires it for some non-market loans. But here's the nuance. If the loan is immaterial, or if straightforward shareholder loan without special conditions, you don't automatically split it into debt plus equity. You still report the full obligation as a liability, and you disclose the terms. Unless the facts explicitly require discounting, treating the missing interest as equity is overcomplicating it. So while it sounds smart, it's a trap. Choice D says, recognize the loan at 100,000, but classify it as equity because it's from a shareholder. This is a classic confusion point. Unless there's a formal conversion into stock, a loan is still debt. Borrowing from your shareholder doesn't mean they suddenly own more of the company. It's still a payable, just with related party disclosure. So this option is wrong. So after carefully walking through each choice, the best answer is clearly choice B. The loan is recognized at 100,000, classified as a long-term liability, presented under notes payable, and disclosed in the notes as a related party loan. Now, let's talk exam variations. What if the loan were due in 6 months instead of 3 years? Then the classification flips. It becomes a current liability. What if the loan had unusual terms, like 10 years at 0 interest? In that case, GAAP might require discounting to present value, and the difference could be treated as an equity contribution. That's the deeper level examiners sometimes test. Or what if the shareholder had the option to convert the loan into stock? Then you'd consider whether it meets the definition of a convertible instrument. But in this straightforward case, it's debt. The key concept here is that related party loans are still liabilities. You don't ignore them, you don't flip them into equity, and you don't zero them out. You classify them correctly, present them properly, and disclose the relationship transparently. Think of it this way. Borrowing from a shareholder is like borrowing from your uncle. You still owe him the money, even if he doesn't charge you interest. The only difference is, at the next family barbecue, you'll probably get a reminder along with the hot dogs. All right, let's tackle this one, this time on the multi-step income statement. Here's the setup. From the trial balance and other information, the company has the following for the year ended December 31. Sales revenue of $4 million, cost of goods sold $2,500,000, selling and administrative expenses $300,000, interest expense $200,000, gain on sale of equipment $150,000, and an unrealized holding gain on available for sale debt securities net of tax $50,000, a loss from discontinued operations net of tax $100,000, provision for income taxes on continuing operations $180,000. And the question asks, what should be reported as income from continuing operations before tax in a multi-step income statement? All right, let's walk through the structure. Multi-step means we go line by line. Start with revenues, subtract COGS to get gross profit, subtract operating expenses to get operating income, then add or subtract non-operating items like interest and gains. That subtotal is what we call income from continuing operations before tax. Notice I said before tax, so the provision for income taxes doesn't get subtracted yet. OCI items also don't show up here. And discontinued operations, they live down below, after continuing operations. Okay, let's check the numbers. Sales minus COGS, 4 million minus 2.5 million equals 1.5 million gross profit. Subtract selling and admin, 1.2 million. Add the equipment gain of 150, that gets us to 1.35. Subtract interest expense of 200, 1.15 million. That's the subtotal. So the correct answer is 1,150,000. But let's not stop at the math. Let's test each choice. Choice A says 1,150,000. That matches our calculation, so it's right. Choice B says 1,250,000. That's what you'd get if you added the equipment gain but forgot to subtract interest expense. Sneaky trap. Choice C says 1,450,000. This happens if you remembered the gain but skipped both interest expense and selling and administrative expenses. In other words, you stopped too early. Choice D says 1,500,000. That's just gross profit. You didn't subtract anything else, you didn't add the gain. Basically, you froze right after COGS. So the correct answer is choice A, 1,150,000. Now, let's talk exam twists because they love to take this setup and change just one fact to trip you up. What if the unrealized gain wasn't on available for sale securities, but on trading securities? Then it would hit income, not OCI, so you'd add 50,000 to continuing ops before tax. The answer would bump up to 1.2 million. What if the discontinued operations loss was reported before tax instead of net of tax? Then you'd have to be careful. Continuing ops before tax stays the same, but the discontinued item would later need its own tax calculation. They might test whether you know where the tax effect goes. What if the provision for income taxes was left unlabeled and just said income tax expense? Then you'd have to parse whether they meant total tax or just continuing ops. Remember, if they specifically ask for before tax, you never subtract it. And one more sneaky twist. What if that equipment sale was actually the disposal of a major business segment? Then it wouldn't be a gain in continuing operations. It would be part of discontinued operations net of tax. That would pull 150,000 out of the subtotal and drop your answer down to 1 million. So the exam isn't just asking you to crunch the math. They want to see if you can classify every item correctly. Operating, non-operating, OCI, discontinued, and tax. That's the real skill. Think of the multi-step income statement like organizing a dinner plate. Continuing operations before tax is the main dish: meat, potatoes, vegetables. OCI is dessert. It goes on a different plate. Discontinued operations are like leftovers. You don't mix them in with the main course, you box them up separately. And taxes? Well, that's the bill at the end. It doesn't hit until after the meal is finished. So the lesson? Slow down, classify carefully, and always respect the structure of the multi-step statement. That's how you avoid falling into the trap answers. All right, let's take this one. Here's the setup. At year end, the trial balance shows $500,000 sitting in revenue. But when you look closer, you realize that this amount actually came from customers who paid cash in advance for services that aren't going to be performed until next year. Now, the controller went ahead and recorded the whole thing as revenue because, in their words, the cash is in the bank and it's non-refundable. So the big question is, what do we do with that $500,000 on the current year's income statement? Let's go through the answer choices. Choice A says, leave it in revenue, but just add disclosure in the notes. Now, that might sound tempting because disclosure is always important, but disclosure doesn't fix bad recognition. You can't put the wrong number on the face of the income statement and then try to patch it up with a footnote. GAAP doesn't play that game, so choice A is out. Choice B says remove the 500,000 from revenue and record it as unearned revenue on the balance sheet. And that's exactly what we should do. Under ASC 606, revenue is recognized when and only when the performance obligation is satisfied. That hasn't happened yet. The service will be performed next year. So in the meantime, that 500,000 sits as a liability, a contract liability to be precise, because the company still owes the customer the service. When the work is performed, that's when it becomes revenue. So choice B is the correct answer. Choice C says keep the 500,000 in revenue, but reclassify it as other income. And that's just moving the problem around. If the revenue hasn't been earned, it doesn't belong in the income statement at all. Calling it other income doesn't make it magically compliant. That's like moving dirty laundry from the bedroom floor to the living room couch and calling the house clean. It doesn't solve the problem. Choice D says report it as a gain in discontinued operations, and that one's way off. Discontinued operations only come into play when you're shutting down a major line of business. This is just a timing issue on service revenue, not a disposal of a segment. So choice D is also wrong. So the right treatment is choice B. Take it out of revenue, put it on the balance sheet as unearned revenue, and recognize it next year when the services are performed. Now, let's play with a couple of exam twists, because this is where candidates slip up. What if half of the services were already performed by year end? In that case, you'd recognize 250,000 as revenue now and defer the other 250 until next year. What if the payment was for a 2-year service contract? Same idea. You'd spread it out systematically. 250 this year, 250 next year. What if it was labeled as a non-refundable membership fee? Same rule applies. You don't record it all up front. You recognize it over the membership period. And what if it was refundable? Then you wouldn't call it unearned revenue. You'd call it a refundable deposit. But it's still a liability until the company either performs or the refund window closes. So the takeaway is simple. Cash collected early doesn't mean revenue. Revenue recognition is tied to performance obligations, not to cash. That's the heart of ASC 606. Think of it like this. If your gym charges you for a 1-year membership up front, they don't get to call the entire amount revenue on day one. They earn it month by month as they actually provide you access. Same thing here. If the service is for next year, the revenue waits until next year. So bottom line, the right answer is to remove the 500,000 from revenue, record it as unearned revenue, and recognize it in the period when the services are delivered. Okay, next question. On December 1, a U.S. company purchases inventory from a European supplier for 100,000 euros, payable in 60 days. The exchange rate on December 1 is $1.10 equals 1 euro. On December 31, the exchange rate is $1.15 equals 1 euro. What foreign currency gain or loss should be reported in the income statement at year end? A, $5,000 gain, B, $5,000 loss, C, $15,000 gain, D, $15,000 loss. First, breathe. It's a straight foreign currency transaction under ASC 830. Here's the key difference between transaction and translation gain or loss. A transaction gain or loss happens when you have a foreign currency payable or receivable on your books. You remeasure it at the closing rate, and any change, realized or unrealized, goes straight into net income. A translation adjustment, on the other hand, happens when you're consolidating a foreign subsidiary that keeps its books in a different functional currency. That adjustment skips the income statement and goes into OCI until the subsidiary is sold or liquidated. Easy way to remember? Transactions hit income, translations hit OCI. Okay. On December 1, when we bought the inventory, we recorded the payable at the spot rate on that date. The math is simple. 100,000 euro times $1.10 per euro equals $110,000. So the journal that day is debit inventory, $110,000, credit accounts payable, euro denominated, $110,000. By December 31, nothing has been paid yet, but the exchange rate has moved to $1.15 for the euro. We still owe 100,000 euros, and ASC 830 says remeasure monetary items, like payables, at the current rate on the reporting date. So we revalue the payable at 100,000 euros times $1.15 equals $115,000. Compare that to the $110,000 carrying amount, the liability increased by $5,000. When a payable gets bigger because the foreign currency strengthened, that's a loss. At year end, we book debit foreign currency transaction loss, $5,000, credit accounts payable, $5,000. So the correct answer is B, $5,000 loss. Let me say the calculation out loud one more time so it sticks. Initial $110,000 on December 1, remeasure to $115,000 on December 31, change of plus $5,000 in the liability. That change flows to the income statement as a loss for the period. Now, a couple of super important clarifications you'll want to remember for the exam. First, because we haven't settled the payable by December 31, this is technically an unrealized foreign currency transaction loss. But under ASC 830, realized and unrealized transaction gains and losses are treated the same. They both hit net income in the period of the rate change. GAAP does not require you to label it realized or unrealized on the face of the statements. Aggregate it in an appropriate income expense line, often other income expense, unless it's material enough to warrant its own line. Second, notice what we did not remeasure: the inventory. Inventory is a non-monetary asset, so it stays at its historical dollar cost, which was the $110,000 recognized on December 1. Only the monetary item, the payable, gets marked to the closing rate at period end. Two quick don't get fooled reminders. Don't send this to OCI. That's the classic exam trap. Translation adjustments for foreign subsidiaries go to OCI. Transaction gains and losses, like this payable, go to income. Also, don't touch COGS or the carrying value of the inventory at year end just because the euro moved. Inventory stays at the $110,000 historical cost until you sell it. Then it becomes COGS in dollars. Since you're exam-focused, here are a few fast twists they love and how your answer would change, if at all. What if the company settled on December 31 at $1.15? The $5,000 becomes realized, but it's still a loss in net income for the year. Same P&L effect. What if the company's functional currency were the euro? You wouldn't remeasure this payable at year-end. It's already in the functional currency. The U.S. parent would see effects on consolidation via translation. That's the OCI world, not this transaction loss world. What if instead of a payable, you had a prepaid expense in euros? That's non-monetary, so no year-end remeasurement, no FX gain or loss yet. What if you had a forward contract hedging this payable? You'd also recognize the derivatives gain-loss. With proper hedge accounting, some effects might go to OCI, depending on designation, but the unhedged payables remeasurement still does what we just did. Wrap it up in one line you can recite on test day. Monetary items remeasure at the closing rate. Changes go to income, realized or not. Non-monetary items stay at historical cost. All right, let's unpack this one. The income statement shows $600,000 of rent expense, But the leases and payments prove only 550,000 was actually incurred. The $50,000 difference came from a duplicate journal entry. So what do we do? Choice A says, leave it at 600,000 and just disclose in the notes that part of it was a duplicate. That's wrong. Disclosure doesn't fix incorrect recognition. GAAP requires the numbers on the face of the statements to be right in the first place. Notes are supplements, not band-aids. Choice B says, reduce rent expense to 550,000 and correct the duplicate. That's exactly what we should do. Under concept statement number 6, expenses are defined as outflows or using up of assets from delivering goods or services. A duplicated entry is not an actual outflow, and ASC 250 tells us that errors must be corrected by restating the financial statements or adjusting the current period, depending on materiality. So the right answer is to fix it and show the correct rent expense. Choice C says keep 600,000 but reclassify 50,000 to prepaid rent. Sounds clever, but it's not GAAP. A duplicate entry isn't a prepayment, it's just an error. Prepaid rent only exists if you've actually paid for future periods. Here, the 50,000 wasn't a prepayment at all. So choice D says present the 50,000 as a separate line item in discontinued operations or other losses. Absolutely not. Discontinued operations are about disposing of a major business segment. This is just a duplicated expense. You don't move errors into special categories to hide them. So the clean, GAAP-compliant answer is choice B. Fix the duplication, reduce rent expense to 550,000, and move on. So remember, the face of the financial statements has to reflect reality. If $550,000 was the actual rent, then that's what belongs in the expense line. Duplicates, misposts, fat finger errors, they're all corrected, not disclosed away, not reclassified to some imaginary account, and definitely not buried in discontinued operations. ASC 250 makes it clear. Detect, investigate, correct. That's what the exam wants you to demonstrate. All right, before we leave this rent expense problem, let me show you how the examiners love to twist the facts. First twist, what if that duplicate entry actually came from last year instead of this year? Now we've got a prior period error. ASC 250 says if it's material, you don't just fix it quietly. You have to restate the prior period financials. So instead of adjusting this year's rent, you'd correct last year and show a prior period adjustment. That's a tougher scenario, but the principle's the same. Get the numbers right. Second twist, what if we weren't just talking about plain old rent, but about an ASC 842 operating lease? The actual $550,000 would still be expense, but on top of that, you'd also disclose your future lease commitments. You know, those tables that show payments for the next 5 years. The duplicate entry wouldn't change those disclosures at all, but the exam could try to trip you by blending error correction with lease accounting rules. Third twist, what if the company really did pay out $600,000 in cash this year, but only $550,000 applied to this year's occupancy? Well, that's not an error anymore. That's prepaid rent. In that fact pattern, you'd recognize $550,000 as expense and $50,000 as an asset for future use. Totally different treatment, same dollar numbers. That's why the exam always stresses the supporting documents. And finally, one more twist. What if the $50,000 was tiny compared to total net income? Say, just a rounding error for a huge company. ASC 250 allows management to fix it in the current period without going through the drama of a restatement. But here's the kicker. They'd still fix the expense number. You never knowingly leave it wrong just because it's small. So see how it works? The exam writers keep the numbers the same, but tweak the backstory. Prior year, leases, prepayments, or materiality. The key for you is to listen for the context. not just the dollar figure. Always ask, was it a duplicate? Was it prepaid? Was it prior year? Or is it immaterial? That's how you'll nail these every time.